Hello and welcome to this session. This is Professor Farhat. In this session, we're going to look at the alternate treatment for adjusting entries. Now, this is part of the adjusting entries, but this is how some companies might deal with adjusting entries. So this is called alternative treatment. This is not what we learned. This is a bit unusual of what we learned. Why? Because this is another method, alternate treatment. Okay? So some companies, what they do, they choose to debit an expense. When a company prepay an expense, debit that amount on expense. Remember, if we prepay for something, what did we learn? If we prepay for something, an asset goes up, which is called a prepaid, and obviously cash goes down. This is what we learned. This is let's call this the traditional method. The alternate method is to increase an expense immediately and obviously credit cash. So this is the alternate method. Then at the end of the year, doesn't have to be the year, at the end of the accounting period, whatever that period is, 1 year, 1 month, whatever it is, under this traditional method, what we do is we debit an expense and we credit the asset. And this is what we learned. This is what we learned in adjusting when we looked at prepaid. This is what we learned in the prepaid session. So this is what we learned in prepaid session. Now, the alternate method is to treat the prepaid initially as an expense, that at the end of the year, determine if you still have any prepaid. If you still have any prepaid, you debit the prepaid and you reduce the expense. So what you do, this expense gets reduced. This expense that you initially recorded is reduced, and you put prepaid on the books. Okay, so this is the alternate method. The alternate method is this green box, the alternate method. So this is what we're going to be looking at. Okay, so let's take a look at it. So when we receive cash, here's what happens. When we receive cash for future services, we credit revenue. So under the traditional method, so let's first take a look at the traditional method. I will do the traditional method in red. And we're going to do those again in a moment. So under the traditional method, we debit cash, credit unearned revenue. This is the traditional method. Then at the end of the accounting period, we debit unearned revenues, then we credit revenue or service revenue or rent revenue or whatever. Some earned revenue. So this is what we do. So here unearned revenue goes up. Under the adjustment, unearned revenue goes down. Under the alternate method, here's what we do. We assume that all the cash that we receive is revenue, is service revenue. I should put here revenue, not service. This is revenue. So under the alternate method, we debit cash and we credit revenue. Then at the end of the period, we'll see if we have not earned all the revenue, we debit revenue, which that's something not normal. We debit revenue, we reduce revenue, and we credit unearned revenue. So if there's anything unearned, now at the end of the period, we'll determine how much of it is unearned. Okay? Versus the traditional method. The traditional method, under the traditional method, we don't count the revenue until we earned it. Okay, and let's take a look at some numbers. So let's take a look at the prepaid first. So this is the prepaid. So initially, here's what we do. This is what we learned. This is what we learned. Initially, when we buy supplies, we debit supplies and we bought them on account. It doesn't matter. We credit payable. Okay. Then at the end of the period, what we do is we debited the expense and we reduce the supplies because we used up 1,500 of our supplies. Okay, we used up 1,500, therefore expensed it. Under the alternative method, which I'm going to use a different color, under the alternative method, what we do when we buy the supplies on October the 5th, we immediately expense the whole amount. We immediately expense the whole amount, 2,500. Then at the end of the period, we say, well, we still have 1,000. We still have 1,000 worth of supplies. So what we do, so basically what we did is this. Let me do the T account for both. Let me show you the T account effect because it's the same effect. So I'm going to go back and show you the T account. So under the traditional method, here's what you did. This is your supplies. And this is your supplies expense. Initially, you bought the supplies and you put in the supplies account 2,500. Then when you made the adjustment, you debited supplies expense 1,500 and you credited supplies 1,000, and you still have supplies of 1,000 as the balance, and your supplies expense is 1,500. Okay, under the alternate method, what you would do is this. Sorry, go back here. Under the alternate method, what you did is you have supplies. Let me use a different color. You have supplies and supplies expense. So initially what you did, as soon as you bought the expenses, as soon as you bought the supplies, you expense them. Then at the end of the period, what you did is you said, I still have 1,000 worth of supplies. Therefore, you debited supplies 1,000 and you credited supplies expense 1,000 to reduce your expenses. Now your supplies are 1,000, and notice the supplies is 1,000 under both methods. Your supplies account is 1,000 and your supplies expense is 1,500. Your supplies expense is also 1,500. So notice you end up in the same place except how you started. Under the alternative method, you counted everything as an expense. What's the assumption that's being made here? The assumption under the alternative method is nothing's going to be left. Therefore, just expense them right from the get-go. That's what we're saying under the alternative method. Okay? And for revenues, we use the same concept. Under the traditional method, and I will do the T account and show you how it works. First, we receive the cash October 2nd for services to be performed. So we have unearned revenue and we have 1,200. Okay. Then at the end of the period, we earned 400. So we earned 400 of service revenue. Well, what we do is we credit service revenue 400 and we debit unearned revenue 400. Unearned revenue is 800. That's the balance that's still left, that we have left. And service revenue is 400. Okay, that's the service revenue. That's under the traditional method. Under the alternative method, what do we assume? We assume all the cash that we received will be earned. So this is what we assume. Therefore, we have, again, unearned revenue. And we have a service revenue. So what we do, as soon as we receive the cash, we assume the whole thing is revenue. Then at the end of the period, we find out that we have not earned 800. It means we only earned 400. We have not earned 800. Therefore, we credit unearned revenue and we debit revenue 800. Therefore, revenue is only 400, which is the same revenue as under the traditional method, and unearned revenue is 800, which is the same as in the traditional method. So that's the only difference between them. It's how we initially record them. One method, we record the expense immediately. We don't record the expense until later. The other method is we record the expense immediately. And this is basically a summary of what we just did. So the prepaid expenses initially recorded as an asset in the account that has been used. This is the traditional method. Yet what happened if we don't make the adjustment? The assets are overstated, the expenses are understated, and this is the adjustment. So this is what you learned initially, and this is what you need to know. The alternative method is to expense the prepaid. Then you will do the opposite. Then you debit an asset and you credit an expense. To remove expenses and add back to the asset. And this is the traditional method for unearned revenue. And this is the alternative method for unearned revenue. Once again, if you don't know the traditional method, obviously you're going to be confused. This is the unearned revenue lecture for the traditional method. If you have any questions, any comments, by all means email me or see me in class. Make sure you complete your homework, complete your quiz, and if you're studying for your CPA exam, as always, study hard. It's worth it.